Hi there, welcome to the Stockscores Market Minutes for January 10th, 2014. This week's topic, the risk of hot stocks. Now, as traders, we all love hot stocks. They're the best way to beat the market. But if you trade them in the wrong way, you can really suffer crushing losses. The key is buying these hot stocks at a point where the reward potential justifies the risk. We want to be conscious of where is the stock price relative to support on the chart, relative to a place where we can put our stop loss order. If the gains relative to the historic performance of the stock are too high, then it may be that that stock is ripe for a pullback. And so we always have to be conscious of where the stock is relative to where the crowd has been buying it. The farther price is from support, the closer it is to resistance. In other words, the farther along you chase the stock, the closer you are getting to the top. Now here's an example of a stock that's done really well over the last 2 days. It's gone from $6 to, well, it closed at just above 14, but actually hit as high as 15.5 on Friday. Now, if we think about this stock, it's a great story, obviously making a big move and pretty exciting, and was a great trade if you bought it at the right spot. Now the question is, what is the right spot? Now buying here when the abnormal activity starts with a stop down here, well, that makes some sense because you can see this trade would have earned you 1, 2, 3, 4, almost 5 times risk. If, however, you chase the stock and you maybe got into it up here, well, look how much farther you are down to that same support level. It's a significant downside risk, and now buying the same stock but at a higher price has much less upside potential than if you caught that stock when it just started its upward move. Now, I always like to look at where stocks are relative to the last period of sideways trading. So buying here relative to this sideways trading, well, that's pretty tight in terms of risk reward. Buying it here relative to that same last period of sideways trading, now that's a much bigger level of risk. Now if we consider this breakout over here relative to this period of sideways trading, we can say, well, buy it here with a stop there, and maybe that makes a little more sense. Now because the stock has run up quite a bit already, certainly the probability of success is lower up in this range, but still, because we've had this base form, we can put our stop down around 13.5 and making the risk reward potential that much better if the stock does in fact continue to run higher. I just don't like buying something where it's been going up bar after bar after bar. I want to buy things when they're just starting a move out of sideways trading, because in that case the reward potential is good enough for the risk of the trade. All right, let's get into this week's market analysis. The first bit of 2014 was, I would say, a little bit of a sideways consolidation. We had some profit taking. We had still the bulls are in control. In the big picture, this is a weekly chart going back 3 years, the long-term trend for the S&P 500 is up, and so we should remain bullish. But looking at the shorter-term chart, this is a 30-minute chart going back 30 days, you can see that the market is in a little bit of a catch-a-breath phase here. We've got the market trading sideways. For most of January thus far, we've really just been going sideways, and that may be an omen for what we're going to see in 2014 after the considerable gains of 2013. Perhaps we now see a market that's taking a break, not necessarily falling off, not necessarily moving higher, just kind of going sideways. That's certainly how the first full trading week of the year went. The TSX benefited from really a strong bond market in the U.S., lower yields, a drop in the U.S. dollar, and really what happened on Friday was that the U.S. jobs number was a lot weaker than expected. That makes investors think that there will be more stimulus from the U.S. Federal Reserve. That's good for any emerging market, but also any commodity-based market, and that helped the Canadian market make a nice gain last week, and it looks like that upward trend will continue until it hits resistance at the red line. So I'm basically bullish on the Canadian stock market. There you can see the break of the downward trend line on U.S. Treasuries that was caused by that weak job report that hurts the U.S. dollar because it implies that the U.S. Fed is going to continue to print more money, continue to stimulate the economy, specifically the U.S. economy. Really, the global economy gets stimulated by the money printing that the U.S. does as well. And so that caused bond prices to go up, bond yields to go down. That's actually good in many ways. It helps consumers. And this looks to me like something that could continue in the near term. Everyone was expecting that interest rates were going to go up, but when that weak jobs number came, now people are scratching their heads a little bit and saying, well, maybe it is not the beginning of rising interest rates like we thought. That helped the Chinese market get some stability after 4 or 5 down weeks in a row. I think the Chinese market will hold support here and bounce. The emerging markets, a similar situation. They've been sliding lower for the last couple of months. But like the Chinese market and really like all emerging markets, this is really just a sideways, boring market. We're oscillating between support and resistance. There is no trend here. And so I'm really not interested in trading these markets because, as we all know, the trend is our friend, and these markets have no trend. The US dollar has been trying to bounce off support. I've drawn support on the green line, and it looked last week, or at least the week prior there, that we were going to get a good bounce off support. But when that weak jobs number came out of the US, that sort of hurt the bounce. Again, still lots of support here for the US dollar, so I'm not writing this off yet. But it is interesting that the bears still seem to be wanting to sell the US dollar. Gold had a break higher from a rising bottom. In a very short-term sense, that's bullish, but big picture here, we're still in the downward trend line, so don't get too optimistic about gold yet. It's made one small step in the right direction if you are a bull, but it has many more big steps to take still. The oil market has fallen back to support. We can see that support has been touched multiple times. It touched it again late last week and looks like it's trying to hold there, but there is pessimism building in the oil market, and so I'm not really one to be too optimistic about the oil market, although many of the oil stocks look okay because money is rotating out of some of those hot sectors and into the oil sectors, which still have pretty good earnings. U.S. stocks, bullish long-term, I think neutral short-term. We're just in that sort of catch-a-breath phase for the U.S. stock market in the short term. Canadian stocks bullish on both short and long-term. Now, the big jump on Friday may bring some very short-term profit-taking early this week, but the picture remains bullish going out beyond a few days. Gold market neutral on both accounts. They're trying to break higher on gold in the very short term, but there's a lot of resistance that it's got to fight. So I like what's slowly starting to develop in gold, but I think that there's still a lot of work to be done. The similar situation in oil. We've had a pretty strong sell-off the last couple of weeks, hit support, so it should bounce. But the big picture is that pessimism is building in the oil market. U.S. stocks are consolidating after the recent strong gains, while Canadian stocks are building upward momentum to catch up to the U.S. market. Gold and oil are fighting to hold support and may show optimism in the short term, but they've got lots of pessimism to overcome in the long term. That has been the Stockscores Market Minutes for January 10th, 2014. Have a great week in the market and trade well.